CPM Group's coveted gold yearbook came out on Tuesday. Here to talk about some of the key findings is the firm's founder, Jeffrey Christian. He joins me from New York. Jeff, thanks so much for being with me.
It's my pleasure to be here.
All right, Jeff, let's talk about gold's forecast. From what I understand from the yearbook is that CPM is expecting gold prices to remain high, but we may not see those record-breaking prices we saw in 2011. Is this correct?
Right. I mean, a year ago, we were saying that we thought that gold prices would reach a cyclical peak over the course of 2011, and that they would stay high but come off a little bit and not make new highs going forward. And what we think we see is a cyclical peak having been reached in August and September of last year. The price has come off. It's actually come off sharply since that time, but it's bouncing around between, say, $1,560 and $1,790. It's $1,700 as we speak right now, or $1,686. So our expectation is the price is going to stay high by a historical standard, but we may have seen a cyclical high for a few years now as of last year.
All right, Jeff. So what will be some of the key factors weighing on the price of gold in 2012?
Well, the main factor to watch is investment demand. You know, gold prices rose from $270 to $1,900 over the last decade because investors were buying enormous amounts of gold. And investors were buying that gold because they were concerned about a host of economic, political, and financial problems. What we've seen since September is that investors are still concerned about those economic problems, but they're somewhat less concerned than they had been prior to, say, September of last year. It's not that those problems have gotten better. It's not that those problems have been solved. It's just that investors, I think, are shifting from an attitude of, I must buy gold today regardless of the price because the euro could collapse tomorrow or the treasury could collapse tomorrow. And investors have shifted from that attitude to an attitude of saying, these are long-term problems, governments are trying to deal with them, and it's going to take many years to resolve them. So I think what you're finding is investors are saying, I still want to buy gold and silver, and I still want to buy enormous amounts of gold and silver, but I can afford to be price sensitive. So if I see the price ramp up to $1,790, as it did 2-3 weeks ago, I can pull back from the market and not buy. I don't have to chase the price higher the way I did last July and August. And similarly, if I see the price spike down $1,620 as it did last week, I can step up and buy gold. And so last week we saw an enormous amount of gold purchased by investors because the price had come off from $1,790 to $1,620, $1,640, and people took that as a buying opportunity. And I think that that's what we're going to see. We're going to see price-sensitive investment demand going forward.
All right, Jeff. So are investors viewing gold less as a risk asset and more as a safe haven, would you say?
That's one way to look at it. The way we verbalize it is we say that investors have backed away from buying gold regardless of the price because of fear of imminent financial collapse, to instead they're buying gold in a price-sensitive way as a safe haven investment from a long-term perspective.
So the yearbook states that investment demand in 2011 fell by 5.8%. Do you anticipate this to fall even further in 2012?
No, we expect investment demand to be relatively stable, roughly around the same 34 million ounces that we saw last year in 2012. And you have to take that 5% decline in context. I mean, it went from 36 million ounces to 34 million ounces. These are enormous volumes of annual purchases of physical gold by investors on a historic basis. I mean, it's very unusual. It's unprecedented prior to the last decade to see investors buying that much gold in a given year. And so even though we saw a 5% decline, investment demand at 34 million ounces was still an extremely high volume of gold being purchased by investors.
And Jeff, what are you finding? How are people holding and buying gold? Is it physical? Is it ETFs?
The vast majority of the gold is being bought on a physical basis. I think ETFs probably represented about 15% of investment demand last year, and that was down from about 22% in 2008, 2010. So you have seen some reduction in investment demand through the ETFs, but the vast majority of the gold is being bought in a physical basis, not through ETFs. A lot of it in India and China, but also in the United States, Europe, and really around the world.
Jeff, you just touched upon India, and I'd like to know if you think Indian gold fabrication demand will increase in 2012.
Well, right now, India is going through some problems because the Indian government has imposed tariffs on imports of gold. And now today they also imposed tariffs on gold jewelry imports. Our expectation is that those tariffs may be rescinded or rolled back somewhat. But even if they aren't rescinded, we think that it's a temporary blip in investment demand because we think that investors in gold in India who buy gold jewelry as a form of gold investment will continue to buy, and they'll adjust to the idea of the tariffs if the tariffs stick. So we think it's a temporary negative factor on jewelry demand in India that will go away one way or another over the next couple months.
So, Jeff, do you think the Indian government wants to avoid the population investing in gold because it doesn't help boost the economy? What are the reasons for these restrictions?
That's part of it. I think part of it is that they're running large current account deficits, and a big part of it is gold imports. So they would like to improve the economic performance of the country. Second thing is that people are importing a tremendous amount of gold, and a good way for the government to raise revenue is to tax those imports and to increase the taxes. And we've seen this in the distant past. In the 1990s, you'd see the Indian government put a tax on gold imports. It would be too high. There'd be a strike, as there is this week, in the market, and they would lower it to something higher than it had been, and then investors would start buying again. So I think the Indian government is trying to raise revenue for itself. It's trying to improve its current account deficit situation, and there is and has been for decades, since going back to the 1960s, the Indian government has tried to restrain gold demand on the part of Indian investors, partly because it's a sterile asset and it doesn't necessarily help the economy. And you have a much higher incidence of gold representing a store of value in India than you do in China, the United States, and virtually any other country. I mean, about 30% of private wealth is stored in gold and silver in India. So that is a lot of money that's taken out of circulation. It's not invested, it's not saved in rupees, where it's available for banks to lend to people. So the Indian government definitely has some of that macroeconomic policy factor in mind when it raises the tariff like this.
So many factors to watch in 2012, Jeff, but just to recap, if we can look again at the trading range you're anticipating for gold in 2012.
We're probably looking for a low around $1,500, $1,520, and a high probably around $1,800, which we almost saw yesterday. Or no, we almost saw $1,700, I'm sorry. I think that it could spike back up to $1,790 as it did a couple of weeks ago, but I think that those spikes to higher levels will be fewer, and the higher levels to which they spike will be lower.
Now, Jeff, is this within the next 6 months?
Within the next 9 months, yes.
Any final thoughts regarding the yearbook, Jeff?
Well, I will clarify one thing. I just said the difference between 6 months and 9 months from now is that within 9 months we will have had a U.S. presidential election. Yeah. I think the yearbook, look, the yearbook does some really great stuff. It provides a tremendous volume of very good data that people won't find anywhere else. And it's much more accurate than any other data that's in the market on gold physical supply and demand. But it also provides a really good analysis of what's going on in the market and why the prices have been doing that.
Jeff, you just mentioned the presidential election before. How do you anticipate gold prices could change if the Democrats stay in power or if there's a Republican win?
It's really difficult to say. I think that the election itself will have some sort of effect. What that effect will be is hard to say. It may not be as dynamic as one would think because it may be a race of milk trucks and with little distinctions between the two sides. And then I think regardless of who wins, there will be an effect on gold because people will look at it and they'll say, well, if the Republicans come in, they're going to roll back taxes. They're going to continue to increase spending and deficits will get larger again. And if the Democrats come in, it'll be the opposite. And regardless who wins, it's probably going to be stalemated government continuing in the United States.
Thank you so much, Jeff. I know we here at Kitco News urge everyone to get a copy of the Gold Yearbook. We rely on it heavily for our background information, so thank you. And where can people get a copy if they are interested?
They can go to our website, www.cpm-group.com. They can order it either as a PDF or as a printed volume or both.
All right, thanks again, Jeff, and thank you for watching Kitco News. You can email me, as always, at newsfeedback@kitco.com. For Kitco News, I'm Daniela Cambone.